Here's a strange thing that happened last week. A company reported a $253 million loss. The company stock surged 35% that same day, then fell 12% the next morning. And now, as of this recording, 7 Wall Street firms have collectively raised their price targets by an average of 68% in one day. The company's Hut 8, ticker HUT. If your read on this is Bitcoin miner reports of massive loss, you're reading the wrong headline. In this video, I want to do something most people won't bother doing. I want to actually read the 10Q. I want to go through the footnotes. I want to build the DCF, and I want to compare it, honestly, to every meaningful competitor. And by the end, I want you to understand exactly why the loss is mostly fake. What the bond they just closed actually means for the credit quality of this business, and what price target makes sense in the bull case, the base case, and the bear case, because all three are legitimate. Let's get into it. First, let's establish what Hut 8 actually is, because most of the disclosure is still stuck in 2022, when it was just a pure Bitcoin miner. It's not that anymore. Today, Hut 8 reports 3 business segments. 1, power, generating revenue from operating power assets. They actually sold their last major power plant in Ontario this quarter to a company called TransAlta. So this segment is shrinking by design. 2, digital infrastructure. This is the new growth engine, and it's where all the excitement is. Riverbend in Louisiana, Beacon Point in Texas. These are the AI data center campuses. Here's the irony. Right now, the segment only generated $1.3 million of revenue this quarter. $1.3 million, but it holds $16.8 billion of contracted lease revenue. The cash just hasn't started flowing yet. That begins in 2027. 3, compute. This is the current cash engine. $66 million of revenue in Q1, mostly, almost entirely from Bitcoin mining through their subsidiary, American Bitcoin. This is what pays the bills today, while the AI data centers get built. Now, and this is important, Hut 8 doesn't own 100% of American Bitcoin. They own about 55%, and the other 45% belongs to outside shareholders. Why does this matter? Because accounting requires Hut 8 to consolidate 100% of American Bitcoin's financials into their books, including all its losses. But they only economically own 55 cents of every dollar. That's why you see a $33 million loss attributed to non-controlling interests line at the bottom of the income statement. It's basically the minority shareholders absorbing their share of the losses. Keep that in mind. It'll matter when we get to the valuation. All right, let's run through the headline numbers before we dig into the story behind them. Revenue, $71 million. That is up 226% year over year. A year ago, this company was doing about $22 million a quarter. They've more than tripled the top line. GAAP net loss, $253 million. That number's going to look scary. We're going to take it apart piece by piece in the next slide and show you why it's largely an accounting artifact. Cash plus Bitcoin, $1.3 billion. That's liquidity. That's not nothing. Contracted leases, $16.8 billion. 12 months ago, that number was zero. Zero. That context matters. And diluted shares, 112.5 million, up 13% year over year. That share count growth is something we'll come back to, because the dilution is real and it's structural. But the number I actually want to highlight, the one Wall Street is paying attention to, is adjusted EBITDA, excluding Bitcoin. $45 million. Analysts expected $28 million. That's a 60% beat on the metric that actually measures how the operating business is performing. Almost nobody's talking about that. Okay, this is the most important part of the video analytically. This is where we earn our stripes. Look at the waterfall chart on the screen. Let me walk you through every bar from left to right. Revenue, positive 71 million. Cost of revenue, negative 25 million. That gives us a profit of 45.5 million dollars at 64% gross margin. A year ago, that margin was 15%. The business is genuinely getting more efficient as it scales. Then we hit depreciation and amortization. Negative 38 million. That's real, and the hardware wears out. The data centers depreciate, but it's non-cash. Then G&A. Negative 82 million. That looks terrifying until you pull it apart. About 51 million of it is stock-based compensation. Employees being paid in shares, not cash. More on that in a minute. And the actual cash G&A is closer to 30 million. And then we hit the bar that causes all the confusion. Bitcoin mark to market. Negative $296 million. This is HUD 8 holding 16,331 Bitcoin on their balance sheet, and Bitcoin's price fell during Q1. Under current accounting rules, this is GAAP, generally accepted accounting practice. This is required. They have to mark that the entire portfolio to market every single quarter. That is not a cash loss. They did not sell the Bitcoin. They did not lose that money. The coins are still sitting there. It's an accounting entry, but it runs through the income statement and makes the loss look catastrophic. And here's the other side of it. They also booked a $41 million gain on derivatives. These are Bitcoin put options and covered calls that they use as a partial hedge. So the Bitcoin mark hurt them The Bitcoin mark hurt them to 96. The derivatives helped them 41. The net Bitcoin drag was about 255 million, almost exactly the entire loss. Then you've got $34 million gain from selling the Far North power plant to TransAlta in February. That's one time. It doesn't repeat. And a $49 billion income tax benefit, which is a real accounting item driven by deferred tax assets. Net it all out, $253 million loss. But the operating business, stripped of crypto accounting noise, generated 45 million of adjusted EBITDA. That's the real number. That's 60% above what analysts expected. Now let's look at the balance sheet, because this is where you see the transformation happening in real time. Total assets are $2.6 billion, actually down slightly from the last quarter. But don't be misled by the headline. The composition is what matters. First, property and equipment grew by $169 million in one quarter to $812 million. That's the data center being built. Concrete, power infrastructure, cooling systems. That's real CapEx turning into real assets. Second, the Bitcoin holdings. 16,331 Bitcoin, worth about $1.1 billion at quarter end. This is split three ways. 436 million held in custody. 211 million pledged as collateral for minor purchases, and 478 million pledged to secure the Coinbase credit facility. Here's the risk sizing you need to do on this. If Bitcoin falls 20%, HUD 8 records about 225 million in additional unrealized losses. That's non-cash, but it's ugly on the headline. If Bitcoin falls 40%, you're looking at 450 million. This is real tail risk. Not because the company goes bankrupt, but because the market reaction can be severe. And third, this is the most important structural point. After the Cotu convertible note converts, which is expected to happen in late Q2 this year, Hut 8 will have essentially zero recourse debt at the parent level. That's the capital structure of a mature data center REIT, not a speculative miner. That's the transformation in one sentence. Okay, this is the part of the video where I say almost nobody talking about Hut 8 right now is covering this correctly. You've probably heard the Riverbend narrative. Hut 8 signed a 15-year, $7 billion lease with a company called FluidStack, and Anthropic's AI models are going to be the compute load. Great story, lots of YouTube videos about it. But here's what almost nobody's mentioning. The actual credit risk on that lease is not FluidStack. Based on every piece of evidence in the filing, it's almost certainly Alphabet. Now, Hut 8 has never officially named the backstop provider of their public filings. The 10Q refers to a confidential high investment grade company, but the bond pricing documents describe the credit structure in specific enough detail that the market has widely concluded who it is. Piper Sandler named Google directly in their post-print analysis note, and the credit ratings match almost nobody else at this level. Here's the relevant language from the April 27th bond documents. Quote, Google provides a financial backstop covering all lease payments with novation rights inside the first 6 years and a springing Alphabet guarantee that activates if Google revenue falls below 50% of the consolidated Alphabet revenue. Let me translate that into plain English. If FluidStack, which is a private, pre-profit AI compute startup, if FluidStack ever can't make a lease payment, Google steps in and covers it for the entire 15-year base term, and that's a backstop to the backstop. A springing Alphabet guarantee. If Google's own revenue were to fall below half consolidated Alphabet's, now, again, Hut 8 hasn't officially confirmed this is Google, but that bond language was filed publicly. Draw your own conclusions. The credit ratings described in those documents, AA+ from S&P, AA2 from Moody's, match Alphabet's current ratings exactly. At that rating level, you're talking about a tiny handful of companies globally. The market has made its inference, and whoever this tenant actually is, those ratings are equivalent to the United States government in some frameworks. This is not a startup lease. This is a 20-year annuity, effectively guaranteed by one of the most creditworthy entities on Earth. And this is exactly why the bond market lent Hut 8 $3.25 billion at 95% loan to cost. At investment grade terms on a construction project that hasn't opened yet. The bond cleared because the underlying credit profile is AA+ or AA2. Whoever that tenant formally is, full stop. That changes the discounted cash flow completely. You don't discount an investment grade guaranteed cash flow at 10%. You discount it at something much closer to treasury rates. The market hasn't fully priced that in yet. And one more thing on Beacon Point. Their new Texas lease, the $9.8 billion one, they announced this week. Management confirmed on the earnings call that the tenant is not Google, not Anthropic, not FluidStack. It's a different, undisclosed investment-grade counterparty. We don't know who yet, but the fact that they're already getting a second tenant into a different site shows that the model is working. I want to spend real time on the risks, because a balanced analysis has to. There are two things the bulls are not talking about loudly enough: Risk 1, Bitcoin. The company holds $1.1 billion of Bitcoin on its balance sheet. That's not a small number relative to an $8.5 billion market cap. Every 20% move in Bitcoin price means roughly $225 million of unrealized P&L, positive or negative, flowing through the income statement. If Bitcoin has a serious drawdown in 2026, further than it already has, say 40 or 50% again, you could see another $500 million paper loss in a single quarter. The stock would likely react badly, even though it's non-cash. The flip side, Bitcoin also acts as a natural tailwind if it rallies, and the management team has been clear that they're gradually trying to reduce the company's dependence on Bitcoin as the business matures. The Q2 refinancing, which reduces the Bitcoin pledged as collateral by about 3,300 coins, is a step in that direction. Risk 2, stock-based compensation and overall dilution. This is the one I want you to sit with. Stock-based compensation in Q1 2026 was $50.9 million. A year ago, the same quarter, it was $3.8 million. That's a 13 times increase. Annualized, you're looking at roughly $200 million a year being paid to employees and executives in stock. At the current market cap, that's about 2.3% of the company being transferred from existing shareholders to employees every single year. On top of the ATM equity issuances, Hut 8 raised $125 million through at-the-market stock sales in Q1 alone, and American Bitcoin raised another $110 million. Combined at-the-money activity, $230 million in one quarter. Now, to be fair, this is normal behavior for high-growth AI infrastructure companies. Nebius runs similar numbers. CoreWeave did this before its IPO. But it does mean the per-share metrics matter more than the headline market cap, and you need to discount the intrinsic value calculation for ongoing dilution. Now, I'm not saying this kills the thesis. I'm just saying you need to consider the sizing of your positions accordingly. Now, let's talk about the two announcements that caused the 35% pop on Tuesday, because the market's reaction was justified. Through the follow-through selling on Wednesday, suggests people are also appropriately nervous about the execution overall. Announcement number 1, Beacon Point. 15-year lease, 352 megawatts of IT load, $9.8 billion of base term contract value, Corpus Christi, Texas. Triple net structure, meaning the tenant pays property taxes, insurance, maintenance, operating costs. Hut 8 just collects rent. 3 5-year renewal options that could extend the relationship to 30 years. BTIG estimates the unlevered internal rate of return on this deal at 12 to 13%. That's genuinely excellent for this type of infrastructure. Here's what makes this particularly interesting. Between December's Riverbend deal and this one, Hut 8 doubled its contracted capacity in 5 months. 5 months. That's the repeatability they've been promising, and they're delivering it. Announcement number 2, the $3.5 billion investment grade construction bond. This is the one I'd argue is more important long term because it proves the financing model is institutional grade, 16.5-year tenor, fully amortizing, meaning the debt pays itself off over time, matched against the leased cash flows. 95% loan to cost, led by JP Morgan and Goldman Sachs. And here's the structural deal that doesn't get enough airtime. This bond is completely non-recourse to HUD 8, the parent company. That means if Riverbend somehow hit a catastrophic snag, construction delays, counterparty issues, anything, the lender can only go after the Riverbend project assets and cash flows. They cannot touch HUD 8's Bitcoin treasury. They cannot touch the Beacon Point project. They cannot touch the parent's cash. In project finance, this is the gold standard structure. You ring fence the risk inside the project. The parent company captures all the upside through equity, and the downside is contained. It's exactly how Equinix, Digital Realty, and every mature data center REITs finances their large builds. HUD 8 is just accessed the market for the first time as a company that was a Bitcoin miner 18 months ago. The company's calling this the first single sponsor data center to access the investment grade construction bond market. I believe that's accurate. It's a new template for how these projects get financed. And if it works, every AI data center developer in the country is going to be studying this playbook. One practical detail: at closing, HUD 8 got $184 million of equity back. That's cash they can now deploy into the next project. The model itself, the model is self-funding. This chart is the entire bull case in one visual. On the left, December 2025, 245 megawatts contracted, $7 billion in lease value. 5 months later, 597 megawatts, $16.8 billion. The annual NOI run rate, once both campuses are operational, is approximately $1.1 billion. And remember, HUD 8's current market cap is $8.85 billion. I guess at the moment it's risen a little bit above that. You're paying roughly 8 times the run rate net operating income for a business that isn't generating that NOI yet, but has signed contracts saying that it will. The question the market is wrestling with is whether you trust the execution. Riverbend delivers in Q2 2027. Beacon Point Phase 1 follows Q3 2027, 1 quarter later. So by late 2027, you should have both campuses generating cash. Between now and then, the story lives on pipeline progress and not yet cash flows. To understand whether HUD 8 is cheap or expensive, you need to compare it, but no single peer group works here. So I'm using 3 tiers. Tier 1, the direct peers, IREN, Wolf, CIFR, Riot, Mara, all Bitcoin miners who pivoted to AI data centers. Let me run through the comp table on the screen. On EV per megawatt of total pipeline, HUD 8 is the cheapest in the group at 1.06 million per megawatt. IREN, Wolf, and CIFR all trade between 5 and 5.5 million per megawatt. So on pipeline basis, HUD 8 is trading at a significant discount. But here's the nuance. HUD 8's pipeline is largely uncontracted. Most of the 8,300 megawatt pipeline is still in diligence and exclusivity. You're paying for optionality, not locked-in cash flows. So the discount partly reflects appropriate execution uncertainty. On contracted backlog quality, I'd argue Hut 8's is the strongest in the group because of the AA plus and AA2 backstop on the Riverbend and a credit profile the market has widely identified as alphabet. Something Wolf's Fluid Stack and Core 442 deals don't have. So you're getting better counterparty credit at a lower pipeline multiple. That's genuinely interesting. Mara is the only cautionary tale. No AI traction, no data center deals of note, market paying barely $2 million per megawatt of pipeline. That's what the no pivot discount looks like, and it should scare anyone holding pure miners that haven't made the transition. Tier 2, data center REITs. Equinix and Digital Realty, these are the companies Hut 8 aspires to be valued like. Equinix, $80 billion market cap, $1.2 billion of quarterly EBITDA, 51% margins, trading at about 24 times forward EBITDA. Citizen just set their Hut 8 price target at $140, using 17 times 2028 estimated EBITDA. That's the exact same multiple as DLR and Equix trade at today. The whole analyst argument is if Hut 8 executes, it deserves REIT level multiples. Right now, you're buying it before the REIT multiple gets applied. And here's the margin story. Hut 8's triple net leases at scale should produce 85% plus net operating income margins. Equinix runs 51. Digital Realty runs 45. The reason is simple. It's a triple net lease. The tenant pays for everything. Hut 8 is just the landlord. Every dollar of rent is almost pure net operating income. Tier 3, Nebius, the strategic contrast. Nebius is not a Hut 8 competitor in the direct sense. They're the opposite physiological bet on the same TAM. Hut 8 is the landlord. Own the building, own the power, let someone else worry about whether the GPUs become obsolete in 3 years. Triple net lease, take or pay structure, essentially guaranteed cash flows for 15 years. Nebius is the operator. They own the entire stack, the building, the power, and the 40,000 plus GPUs. They're building a cloud platform and selling compute on a usage basis to enterprise and AI startups. $35 billion market cap, $46 billion contract to backlog with Meta and Microsoft, but they're burning cash at a frightening pace. 16 to 20 billion in capex just in 2026, and currently running a negative 113% operating margin. Now, I still think that they'll probably do quite well, but they are using a whole lot of cash. Here's the question. The market is currently paying about twice as much for Nebius's revenue as Hut 8's contracted megawatts. Nebius at 65 times scale, 65 times sales, Hut 8 at roughly 30 times. Is that right? Maybe. Nebius's upside is higher if they execute, but Hut 8's downside is better protected. You can't obsolete a building the way you can obsolete a GPU. Both can win. The bet you make depends on whether you think AI compute is going to be a commodity, in which case the landlord wins, or a differentiated platform, in which the vertically integrated operator wins. So before I start, I need to stress that this is not financial advice. I'm not a financial advisor. You shouldn't even listen to me. And please, invest at your own risk. If you need a financial advisor, I would suggest you go and seek one out. And one final disclaimer, The current stock price does not match up with what we're trading at today. I built this last week. At this moment, we are trading around $100. I did the calculations last week, so they are slightly different for the actual upside potential at this time. Keep that in mind. All right, let's talk about HUD 8. About what HUD 8 is actually worth. I want to be honest about the uncertainty here, because anyone who gives you a single clean price target without showing their work is doing you a disservice. I built a sum of the parts model, and I'll walk you through each component. The chart on screen shows you the per share breakdown. Component 1, the contracted lease portfolio, I discounted the Riverbend and Beacon Point cash flows at 10%. That's a fairly conservative WACC for IG grade cash flows. Present value of the lease cash flows comes to about $62 per share. Subtract the $3.25 billion of project debt. That knocks off about $29 per share. Net equity value from the contracted leases, $32.57 per share. That's your floor. That number is relatively defensible. You need to seriously stress the discount rate or the NOI projections to get it meaningfully lower. Component 2, cash and Bitcoin. Cash is $160 million. Bitcoin attributed to HUD 8 shareholders, adjusting for the minority interest at ABTC, is about $7.17 per share. American Bitcoin's own attributable assets add another $4.41. Component 3, the bond closing equity. That $184 million returned to HUD 8 when the project bond closed, about $1.60 per share. And then component 4, the pipeline. This is the swing factor, 8,375 megawatts of development pipeline. If you assume HUD 8 converts 50% of it into signed leases at similar economics to Riverbend and Beacon Point, and you apply a 30% probability weight and a 10% discount rate, you get to roughly $110 per share of option value. Total intrinsic value, $155.81 per share versus a current price of $78.64. That's about 98% implied upside. Now remember, that was from last week. We have gone up since then, so that has changed a little bit. But the intrinsic value should stay the same. Now, here's what you need to understand about that model. 70% of the intrinsic value comes from that pipeline option. If the pipeline doesn't convert, if they sign no more leases or deliver the existing ones late, that $110 of pipeline value collapses down towards zero. And you're left with a stock worth about $45 to $50 on the contracted assets alone. Now, I do want to say, anybody who's gotten in recently in that $40 range before it shot up, congratulations. That was good. There were some really good calls there. So the honest summary is, if you believe in the pipeline, the stock is roughly 2/3 of today's intrinsic value. If you don't believe in the pipeline, it's potentially fairly valued to slightly expensive right here. So make sure you consider everything. For reference, the Wall Street consensus agrees with the bull direction. 7 firms raised price targets after this print. The average new target is $131. Clear Street is at 148, the highest. BTIG is most conservative at 115. All 7 are buy or outperform. Note that the previous average was about $78, slightly below the current price. These upgrades essentially reflect analysts embedding the 2 new announcements into their models for the first time. Let me close the analysis section with 3 explicit scenarios, because the uncertainty here is real and I want to be transparent about that. The bear case, $40. What has to be true? The development pipeline fails to generate new signed leases beyond what's already contracted. Bitcoin takes a serious hit, 40% or more, creating multiple quarters of massive paper losses that spook institutional holders. Riverbend delivery slips past 2027. Stock-based comp dilution accelerates. This is a plausible scenario. The $40 bear case essentially prices out all the pipeline optionality and assumes a material Bitcoin hit simultaneously. It's not a company destroying outcome, but it's a painful 50% drawdown from here. Now, the base case, $80 to $100. Riverbend and Beacon Point deliver on schedule in 2027 and begin generating the contracted net operating income. No new leases are signed in 2026, so the pipeline stays an option rather than a contracted asset. Bitcoin treads water between 60 and 100,000. The stock gets a modest re-rating as cash flows start materializing. This essentially prices the current situation fairly. You're at the base of the range right now at $78. Again, a couple days ago. We're right around the top of the base case currently. Bull case, $155 to $200. Hut 8 converts the Anthropic pipeline. There are reportedly a gigawatt of sites under joint diligence with Anthropic. If 3 to 5 of those get signed to long-term leases, each with Alphabet-style credit backstops and 12 to 13% IRRs, the pipeline option value explodes upwards. On top of that, as cash flows from Riverbend start materializing in late 2027, the market re-rates the stock from construction stage speculative to income-producing infrastructure. This applies at Equinix level multiples. At that point, the math gets to $200 or beyond. My honest review, I think the base case is roughly where we are. The bull case is real but requires execution over the next 18 months. The bear case is a tail risk, and you need to size your position against how likely you believe that is. Here is what I want you to take away from this video. 1, the loss is fake. $253 million, 95% of it is non-cash accounting. The actual operating business beat estimates by 30%. 2, the lease quality is real. A tenant with AA plus and AA2 credit, widely understood to be Alphabet, backstops the Riverbend lease payments. That is not a startup bet. The bond market just validated that by lending in investment grade terms on a construction project. 3, the pipeline is the entire bet. 70% of intrinsic value comes from converting that 8,000 megawatt pipeline into signed leases. If they do it, you're looking at something that could be worth double the current price. If they don't, the floor is around $45 to $50 on contracted assets alone. 4, the risks are real but sized. Bitcoin exposure, structural dilution, execution risk on 2027 delivery. These aren't fatal flaws, but they're not nothing either. Position size your positions accordingly. As always, this is not financial advice. I'm a person on the internet who read a 10Q, not your financial advisor. I'm not your advisor. Do your own research, think through your own risk tolerance. If you found this useful, hit the like button. It actually matters for the algorithm and helps this kind of deep dive content reach more people. Subscribe if you want more of this, and drop a comment. What's your take on the pipeline? Do you believe the Anthropic deal gets signed? I'll be in the comments waiting to see what the Hut 8 bulls think. I'm going to be watching Hut 8 closely between now and the first cash flows. Riverbend in Q2, Beacon Point in Q3. When those campuses turn on, this company either becomes something completely different or the execution miss has become obvious. Either way, it's definitely worth covering. Let me say two more extremely important things. This video never would have happened without two very critical people who deserve the shout out. One of them is my friend Al. I'll give his shout out in a moment. The other is CDN Ricky Bobby, who I consider as a friend and a fellow colleague. See, he and I are members of the ALSTOCKTRADES community, and he put out some extremely powerful data-driven due diligence, and Hut 8 is just one example of many strong callouts. If you are on X and you want phenomenal DD, keep an eye on this guy. His X is tagged in the description down below. Give this guy some love. He puts in a lot of very hard work. Finally, I want you to watch this final parting gift from our community to you. This is our secret sauce. Have a great day, everyone. Before you go, if you want to institutionalize your research process, consider securing lifetime access to ALSTOCKTRADES. Founded by Dr. Albert Allen, the platform gives you permanent, uninterrupted access to over 60 advanced analytical tools and more than 40 years of historical data, all without any necessary recurring subscription fees. To lock in this long-term value, click the link in my description down below. Use code DRAGON at checkout and take a massive $2,300 off your lifetime membership. Replace market speculation with objective, data-driven conviction today. I'll see you in the next video.